Hello, everyone. Welcome to today's presentation by BFSG on retirement readiness, planning for income to last your lifetime. With that, you guys want to advance to the next slide. And Keith and Sophia, would you like to introduce yourself today?
Yeah, great. Thanks, Chad. Again, my name is Keith Johnson. I'm a senior education specialist, financial planner with BFSG. So essentially what I do is help people with investment management guidance, planning for retirement, as well as other various financial planning topics. I've been doing this for 30 years, fiduciary consultant, as is Sophia, and I will turn it over to her for a quick intro.
Thanks, Keith. Hi, good morning, everybody. My name is Sophia Liu. I'm also a financial planner and one of the education specialists here with Benefit Financial Services Group. Because it's a mouthful, we always just shorten it to BFSG. And it's very similar to Keith Johnson. My role is also to help a lot of retirees or people interested in financial planning, talking about the various topics within financial planning, such as planning for education, risk management, estate planning piece of it as well. So it's a pleasure to be here today, everyone.
Yeah, thank you everyone for attending. Much appreciated. Okay, so we're going to start off today just to kind of get a gauge as to everyone on the call. What's your plan as far as when you're looking to retire? And Chad, maybe you can kick that off right here.
I can. Thank you, sir. So for all of you, we haven't actually done a live poll in Zoom for, about like at any point in this session at least, but it should pop up for any of you on a laptop or computer on your screen, a quick question for the group, just to kind of gauge who's on the call today. I think depending on the results, this can actually, Keith and Sophia might have specific insights for the biggest group and then some other insights for the rest of the group. Share results with the group. So we have 9% of people said I'm retiring yesterday, maybe already retired. About 41% say I'm going to retire in a few years, 1 to 4. 20% of people say about 5 to 10 years, 27%, 10 plus years. And there's at least a couple of people out there said probably never. I'm going to work my whole life. Whether hopefully it's because you want to, not because you need to. But part of today's presentation is to make sure that you're in that want category. Keith, Sophia, take it away.
Thanks, Chad. I was going to say, that question, my favorite would be choice number 5, never retire. Not because of financial constraints, but because, you simply love what you do and you'd want to stay active and involved. But in this slide, it's important to manage expectation regarding retirement. So the first chart here, you can see that 70% of the US workers expect themselves to retire at 65 or later. But in reality, though, only 28% of them actually made it to 65. So what happened to the rest of them? Well, they had to retire earlier than expected. So if you look at the middle chart right here, you can see the exact reasons why. The top 2 reasons, excuse me, are due to company changes such as downsizing and, of course, health issues. One might argue that health issue is somewhat within your control, right? Like having a healthier diet, etc. But in general, I'd say these reasons are sort of out of your control and due to external reasons. But if you have a plan where you're working together with an advisor, hopefully you'll be at the purple graph down here. You retire earlier than expected because you could afford to. So Keith, if you can go to the next slide, please.
Yeah, and I was just going to add into that here because just a few years has a tremendous impact on your lifetime income throughout retirement. So when Sophia and I do financial planning, we look at everything holistically. So it's really important to almost plan for the worst case scenario, if that makes sense, right, Sophia?
Absolutely, yeah. If you were expecting to work until 65, but let's say all of a sudden you were forced to be retired at 62, now we have 3 years of gap of income that we have to somehow account for, right, for the expenses.
100%.
Great point. So once you're in retirement, you may be retired for longer than you think, right? This is why we're here today to emphasize the importance of creating a retirement income plan. The first step, of course, is to recognize you actually need a written financial plan. And the second step is recognizing that you don't have to do this alone. If you don't already have advisors, BFSG, we're here to help. You may have a lot of questions such as, will I be able to maintain my lifestyle? Can I retire now or should I wait? How should my assets be allocated? And then there's, of course, the question of all times is, will my money last? And some of you may also be wondering if you will have enough money or leftover money to leave to your loved ones. So these are just some of the many questions that probably brought you here today. But if there's one thing that we want you to, a key takeaway to take away from today's session is that you should absolutely consider a practical, usable plan to navigate this new retirement territory. And Keith and I will show you how easy it can be to come up with one.
Yeah, it's a big one right there, Sophia, as far as will my money last? Sophia and I do hundreds of financial planning appointments every single year. And the number one concern among baby boomers, for example, is my money going to last? So that's where 70% of the wealth in this country is housed. So that's a big thing. So there's a lot of planning that goes into this. And yeah, if you don't have a fiduciary consultant, we're here to help out.
Yep, absolutely. So first, let's consider where your income will be coming from during retirement, because the retirement territory have changed. Now, you might be wondering, okay, Sophia, I've heard you say that term quite a few times now, new retirement territory, but what exactly do you mean by that? Well, retirement for our parents and even for our grandparents was very different back then. So many counted on Social Security and pension benefits to cover for their retirement income needs. But today, I would say many retirees will be more personally responsible for funding their own retirements. So if you take a look at this chart, it shows that Social Security is not the only significant source of income for those who are over 65. Much of the household income also comes from pensions, you have retirement savings, asset income, and also earnings. So this means that your expectations around your lifestyle may be higher than those of your grandparents, which may also means that you're spending more. Well, but the good news is you're probably saved more than your grandparents, and you have also spent longer period of time, if not your entire life, in the stock market. So of course, that, talking about investments, that might add another, complexity to your situation, making our point even more across, or driving the point across is that it's even more important for you to have a roadmap to help you chart your territory through this new retirement age, I should say. Keith and Chad, do you want to add anything before I turn it over to Keith and let him talk about the agenda?
Yeah, Chad, do you have anything?
Yeah, I mean, the one thing I'd add is I think many people on this call do have access still to pension plans, right? I mean, there's still a handful of them in the corporate sector. There's still a handful of them in the government sector where you might have access to pension. And for those of you that have access to a benefit like that, do not take it for granted. You still probably want to save in your 401k. Nobody ever gets to retirement and says, oops, I have too much money, right? That's one of the best problems in the world. But for the rest of you out there, right, pension plans are really for a lot of people going away. It's a thing that we all think was going to be there, and it's just not there anymore. Social Security is your pension plan, and it's for most people, I think, covers less than 40% of their pre-retirement income. And if that's the case for you, I mean, how many people on this call could really live on what's the average benefit, like $1,900 a month? Yeah, I mean, right. I couldn't even pay my mortgage today. So yeah, I think really think through if you don't have access to a pension out there, that you definitely want to be saving even more for retirement. And if you do have access to a pension, just do not take it for granted. It is an amazing benefit for you.
Yeah, no, 100%. I think the onus is now on the employee versus the employer. That's why the pensions have kind of gone by the wayside, so to speak, if that makes sense. So it's in your hands, and just putting that plan together, that's imperative to make sure you're going to be all set. So we'll start today's program with a discussion of the new retirement Sophia had alluded to, and the financial risks that we face in retirement, like inflation, market fluctuations, that's normal. So the stock markets over the last 200 years, and that's a big thing right now. I mean, it's been very volatile, and the markets have gone from lows to all-time highs in a very short amount of time. And then other concerns, they're going to be new, potentially worrisome, actually. But you can count on the fact that by the end of what we go through here today, through this brief presentation, you're going to be armed with the knowledge and strategies that you're going to need to face all these risks head on. So we'll also examine how creating a financial plan can help you in planning for your financial future, your retirement, and so on and so forth. And then finally, we'll just talk about next steps you need to take to begin creating your own plan. So before you can embark upon building a practical roadmap to financial security, we'll need to understand and actually integrate into a plan. There are essentially 5 key risks that can potentially derail a lifetime income plan. Longevity. We're living longer than ever. Healthcare expenses are increasing 2 times the rate of inflation. Right now, inflation is coming down a little bit, but that's always a concern. And then asset allocation, and we'll drill down on this. A lot of folks that they're in fear of running out of money, get too conservative, but if you're not outpacing inflation and taxes, that can be detrimental. And then also excess withdrawals. So we'll talk about all this stuff on the coming slides here. So as this slide shows, an American man who has reached age 65, good health. For example, he has a 50% chance of living to age 87 and 1 chance of living to age 93, which again, going back to that life expectancy. And then for a 65-year-old woman, these odds actually rise to 50% of making it to age 89 and a 25% chance to living to age 95. So the odds that at least one member of in this example, a 65-year-old couple will live to 93 is 50%. And there's a 25% chance that one member of that couple is going to live to age 97. So really important considerations here when we talk about longevity. So when you're doing your planning with your advisor or whoever it is, you should probably plan out well into your 90s and look at that family history. What does that look like? So now we'll just take a quick look at healthcare expenses. As I mentioned a little earlier, I mean, longer lifespans, rising medical costs, declining employer-sponsored medical coverage, and possible shortfalls ahead of a Medicare. Medicare is not in the best shape. Social Security, we'll talk a little bit about that. But this essentially needs to be accounted for when we talk about someone who's getting close to retirement and transitioning into retirement. And this is a Fidelity study that says, okay, out-of-pocket health care expenses for a healthy 65-year-old couple, out of pocket, you could be looking at spending $330,000. So are you accounting for that when you put your overall plan together? Anything to add on, Sophia or Chad?
For me, I just think through it, really put in perspective. It's for a couple that retires at age 65, you're going to live about 30 years, very likely in retirement. And I think for most people, you think you start working between ages 16 and 22-ish. I mean, you work for about 40 years and it needs to fund your retirement for 30 years. So definitely save a lot. And I think $330,000 that effectively is like spending $110,000 every decade in retirement. Yeah. And I think when you put it, it's a surreal thought. Like even if you have $1 million saved, about 30% of it is going to go towards just healthcare expenses in retirement.
Yeah, because when we do our planning meetings with folks, it's okay, the mortgage is paid off, but what's going to replace that expense in retirement, it's usually healthcare. So
Yeah,
that's
and I will caveat because I got a couple people in the chat box already. This is $330,000 for a couple. So really think, was that $165,000 per person in retirement?
yep.
Yeah.
Mhm.
Yeah, no, for sure. Sophia, anything to add there? Or do you want me to move on?
No, I think these are excuse my voice. These are all very valid concerns, right? I think in addition to healthcare cost, I think later we will also talk about long-term care considerations as well. It's just very imperative to start planning because they definitely sneak up on you. And then I've seen it. I think, Keith, you could probably allude to this as well, is that there are times where we meet and talk with people, retirees who did not do proper planning. And, unfortunately, if they're sick, they're sick. They need the care, and the cost is just they're spending down their portfolio because of the healthcare costs. So
Yep.
it adds up really fast.
Absolutely. Yep. Okay, so let's kind of shift over to inflation here. I mean, by definition, so to speak, inflation it's essentially a long-term tendency of money losing purchasing power. And it can have a really negative impact when we look at these plans holistically because it chips away in a couple different reasons. So it increases obviously the future costs of goods and services, erodes the value of assets set aside to meet those costs. So as this slide, when we look at this, reveals eventually relatively low inflation at 2%, that even can have a significant impact on a retiree's purchasing power. So just as a kind of a side note here, the Federal Reserve targets inflation at 2%. So it's important to look at that, the life of the plan there. But for example, I mean, $50,000 of income today may only be worth just over 30 grand in 25 years based just on 2% inflation. At 3%, that actually is going to end up falling by half. So just to 23,000, 24,000 and change. And then at 4%, the decline is really pretty extreme at that point. So really need to account for inflation in your plan if you're looking to retire earlier, just to make sure you don't outlive your income sources. So again, I mentioned this earlier, the number one fear among baby boomers is as they transition into retirement is running out of money. With that said, many become way too conservative in their investments. In turn, you're going to run that risk of not outpacing inflation, taxes, and so on and so forth. So I could easily argue even the most conservative investor, just to keep ahead of inflation and taxes, we do need some equity exposure or stock market exposure. That's the number one reason we invest in the markets. So this graph kind of illustrates what's going on here, but we definitely want to, in every endeavor, outpace inflation and taxes. Otherwise, you're essentially eroding your retirement nest egg. And then again here, when we look at this chart, even the savviest asset allocation strategy, that can misfire without an equally wise strategy for withdrawing the assets. So the withdrawal rate, that can dramatically affect how long your money is going to last. So I mean, for current times, until recently, most people, they have expected overly optimistic withdrawal rates, maybe at 7%, 8%, or even more per year, believing they could count on rising stock markets to basically sustain their lifestyle. But what you don't want to do when we talk about this is have your livelihood contingent upon what the stock market is doing. So you don't want in a situation when the markets are down 20%, you're probably not going to reduce your spending by 20%. So keeping within that, and this is something actually Sophia and I talked about the other day, keeping that withdrawal rate around 4% of whatever the value of your portfolio is, that's within the limits of, okay, yeah, we're going to do a little bit better than that. But these peaks and valleys, living off that can be a precarious situation. And maybe Sophia, you can chime in on something there.
Yeah, I 100% agree. I think you and I had this discussion because many times we sit down with retirees or people thinking about retirement and said, you know, I heard I can, you know, as long as I'm within a certain percentage withdrawal rate from my portfolio, I should be okay. Well, I think the answer is it depends, right? It's not that simple because to uh, Keith's point earlier, if you're used to spending $3,000 a year, a month, for example, or $5,000 a month, all of a sudden, let's say your portfolio dips and the 4% drops down to $2,000 only a month of income, right? It's an adjustment of lifestyle. All of a sudden, you will feel constrained and say, "Oh, I'm used to spending 5,000, and all of a sudden now I'm spending 2,000. That's not enough." So you still will need an adjustment period that will allow you to kind of phase out or get used to, you know, reducing your expenditures. But I think this is a great starting point, at least to review your portfolio and to be mindful in terms of your withdrawal rates so that you don't excess or draw money out too soon.
Hey guys, before you advance, I think we do a lot of assumptions that people, especially when we have a lot of lines, that they make a lot of sense. And I know for most people they do, but for those that, you know, it might take a little bit more explanation. I think just pulling your eyes to like the middle right of that chart where you see 5%. The idea here is over 40 years in retirement, if you had $500,000, if you took out 5% of your portfolio every single year, it would last you about 25 years. And the difference of just 1%, and this is where Keith and Sophia are going back to that 4%. The difference of only taking 4% instead of 5% means you never run out of money. Like your portfolio would actually grow over that 40 years. That 40 years later, you'd actually have more money than you had at the beginning in this 40-year period, right? And obviously you can cherry pick any 40-year period, and other 40-year periods might be different just based on, you know, when you retire and what the markets do at that time. But the other side of that, though, if you were to take out 6%, and that's what all those different lines are that from the left to the right, if you take out 6%, your money didn't even last you 20 years in retirement, right? And so that's just the impact of 1% either direction, right? It could have lasted you 25 years at 5%, less than 20 years at 6%, or never run out of money and actually grow your portfolio at 4%. Just the importance of doing a plan and really just scenario testing, right? Are you on track? Are you 100%, going to be successful, 90% successful, or 110% going to be successful? That's the benefit of just running these scenarios.
Absolutely. Yeah. So, I mean, Chad, you're the chart guy, so you love this stuff. I know that. But generally speaking, the markets, 75% of the time they go up, 25% they go down. Everyone on this call, Chad, Sophia, myself, and everyone who's attending, you're going to go through recessions. You're going to go through downturns. That's all normal. That's like the markets breathing in and out. So that's always going to happen. So again, going back to what I said earlier about you don't want your livelihood contingent upon when the markets are up 20% or down 20%. So yeah, Chad, you coined that perfectly. I like it. So at this juncture, I mean, everyone on the call, I hope you have a little bit of a better idea anyway, how long your savings and investments may need to last, how much you may need to allow for healthcare expenses, again, which are growing 2 times the rate of inflation, how much of your income you may need to increase to keep pace with inflation, and then how risky your portfolio might be. Are you too conservative? Again, that's 90% of your overall returns in your portfolio are derived from diversification. So going in, making sure you have international domestic stocks, small companies, big companies, and actually, Chad, you could probably chime in on this stuff because I think international companies, for example, are trading at a pretty steep discount, aren't they? Or no?
Yeah, honestly, they are. I think a lot of people, especially in the US, we have a home bias, right? We like to invest in companies we know. So you see, big tech companies, Google and Amazon and Apple, you'll get a lot of money from all of us because we know the companies, we love the companies, we love the brands, et cetera. But I think it's definitely a global world. And even some of these big tech companies in the US are getting a lot of their sources of revenue from overseas at this point, right? From Europe and Asia and Latin America. So, it's an ever global economy. In the US, stock market will not always reign supreme. I think even today, at this point in July of 2025, the Israeli stock market, with all things going on in the world and wars and all that in the Middle East, is up over 80% in 2025. It's the number one performing stock market this year so far, year to date, right? And I think nobody would guess that, right? In any given year, any country, any economy might be the best performing economy. We definitely have a home bias here. I think most people are going to overweight to the United States market, and that's definitely paid off. Over the last 10 to 15 years, the US market has reigned supreme. But there definitely is a place of a cause for diversification in your portfolio, because that will not always be the case. I think a lot of people ask our portfolio managers internally, like, why do you have me invested overseas in Europe and Asia? It's because there was a period of time that those were the best performing markets as well. So we just like to have a global perspective.
100%. That's what it's all about. Good insight. Now I'll turn it over to Sophia here, and she'll go through this next slide.
Awesome, thank you. So here are the 4 key steps to creating a financial plan. And working with many retirees or people looking to retire, we can tell you that most people find this process very useful, very helpful. And it could also be confidence building, right? Because to develop a specific strategy that's tailored to your specific situation, that just gives you the clarity and also the peace of mind and also the call to action items. So step 1 is identify your expenses and your income. And then step 2 is to identify, well, how are you going to cover these essential expenses? And number 3, how are you going to fund the discretionary expenses? So we're going to kind of dive into them a little deeper. But the emphasis that I wanted to draw everybody's attention to is actually step 4, which is to review your plan regularly. So this is not a one and done process. Okay, so definitely you will also need to commit to examining, reviewing your plan on a regular basis, at the minimum once a year, I would say, if there's no major changes going on. This plan is designed to be structured yet flexible, so that way you can also monitor it, because your goals and your priorities may shift over the years, and also your situations may also change as well. So over time, we want to make sure we update these plans to reflect those changes. So we can go ahead and dive into each step more specifically into details, and then also, of course, go through a couple examples of the portfolio construction.
And Sophia, as you get ready to jump into this, I did just post in the chat box for everybody. And if you do watch the replay down the road, it will be in the YouTube description. So if you watch it afterwards, in a replay format, it'll also be available. But it's not the exact format that Sophia and Keith are going to go through in the next couple slides for talking budgeting. But it is a workable Excel spreadsheet. There's a long expense form and a short version of it, so you really can pick how much time you want to spend on this. But it is I think in the chat box you probably can't copy and paste it, but you should be able to click it and download it if you would like to. There's a really just easy way to inventory your expenses if you'd like to, based on what Keith and Sophia are about to say, over the next few slides.
Yep.
Awesome. So the first step is to map out the different groupings of expenses and income. So this is where you will likely to identify all your assets that you hold, along with maybe some of the long forgotten savings accounts somewhere. Hopefully we'll be able to dig them up. And what you really want to do in this step is to distinguish between your essential and discretionary expenses. So essential expenses are those you absolutely have to have money for. For example, like housing, healthcare, food, etc. And then, of course, for some people, essentials could also include, memberships to certain clubs or a certain amount of travel and so on. That's essential to them. So everybody is going to be different, but your homework would be to give some thoughts to what you consider to be essential. Then we have the discretionary spending, such as for travel or hobbies or entertainment, going out to eat, etc. That will need to be then covered by any of the remaining assets, if you will. So also you want to consider, right, as you transition or getting ready to transition into retirement, some expenses may increase and some may also decrease when you're in retirement. So while some expenses might decrease in your retirement, like clothing costs, for example, or dry cleaning costs, right, etc. Other expenses such as healthcare that we talked about earlier, and dining out, because now every day feels like a Saturday, are most certain to increase. So since long-term care, of course, we will also address that a little bit, can be costly, you may also consider coverage to have specific coverage that will cover long-term care needs for this potential expenses. And again, here is also the link. I think Chad already put it into the chat box as he alluded to earlier. There is the template form for you to kind of go through that exercise, to sit down and to really be mindful and considerate of what you consider to be, again, essential expenses versus discretionary expenses.
Yeah, and doing this for so long, I can't emphasize enough all those little things that Sophia was referring to, like eating out, getting the Amazon packages on the porch, all that stuff. Those all add up. And it's all those little things. And I can't emphasize enough, like I said, yeah, to be mindful of that, right, Sophia?
Absolutely. I love the Amazon packages. Yes,
I
they
think
do
I have
add
one show up almost every single day.
up. We know
Yeah,
who the shopaholic amongst us is now.
how much are you spending on Amazon, Chad?
No comment.
Okay, cool. So moving
Awesome.
on.
Yeah. Well, next we want to identify our potential sources of income, right? So you can tap into them to pay for, Chad's Amazon packages every day and Keith's eating out.
Yep.
But you also want to highlight the ones that are sort of lifetime, okay, lifetime income streams. And what do I mean by that? So typically when we think of lifetime income streams, we're thinking about Social Security, we're thinking about pensions, and of course, annuities. Right. And in addition, you may have any inheritance that you're expecting or other windfall that you may be expecting as well. And that should also be considered as part of your plan, your income plan. Now, here I wanted to break away and make a really clear note that we are salaried financial advisors, salary financial planners here acting in a fiduciary capacity. So we are not here to sell any insurance products or annuities and so on. But I will say that because we have the expertise and also the experience in those fields, many people do come to us for an unbiased recommendation or opinion. So oftentimes, Keith and myself, we serve as a second pair of eyes to take a look at those annuities to make sure that they actually work for you, right? And not against you, not just become a burden, another expense that adds onto the list. But really that it will work for you, and be integrated as part of your income strategy plan in retirement. Anything else you wanted to add, Keith, Chad?
Not here.
Thank you.
Awesome then. Well, here, now that we have identified, right, our expenses and then also our potential sources of income, you may want to consider using the reliable sources of income that we alluded to earlier, right? The lifetime guaranteed stream of income, such as Social Securities, pensions, and annuities, to pay for your essential expenses, right? Because remember, if they're essential, you absolutely need money for them, right? They're the non-negotiables. So here we again broke it down to further categories or line items as mortgage, property taxes, rent, household maintenance, repairs, all that fun stuff. And in the event that you do have a surplus, you can allocate them towards other financial goals, right? And here, what do we mean by other financial goals? It could be the discretionary expenses, right? Eating out, or maybe you can buy more packages from Amazon, or charitable giving, and legacy planning for the next generation. All right, we can also move on to the next slide. But the bigger question is, well, what if we have a shortfall? What if we have a gap? Well, then you may want to consider converting a portion of your current income or asset into a lifetime income stream. And you might be wondering, okay, Sophia, there's a lot of repetitive words here that you just said. What exactly do you mean, and how do you even do it? So converting a portion of your assets into a lifetime income stream. Well, there are a few options to consider. So one, you can definitely consider purchasing, again, immediate income annuity. Now, I know we sound like a salesman, but it has to make sense, only in the event that it makes sense. So essentially what the strategy does, it converts, you have a one-time payment into the guaranteed, let's say you have a, a carrier or insurer, right? And you pay them a one-time payment, and then it gets converted immediately into a lifetime stream of income because they sign a contract with you. And so here, we're just listing it out as an option, right? Again, at the end of the day, still have to review it on a personal level to see if it makes sense or not. Your financial advisor could also help you set up a systematic withdrawal plan that will automatically take payments from these assets, right? Your portfolio, for example, to generate income and the specific targeted income that you will need to cover your essential bills, right? Like what we talked about earlier, mortgage and property taxes and so on. In addition, you may also want to consider some added protection to your healthcare cost that we talked about earlier, because the rising cost of healthcare. Ask your financial advisor about long-term care insurance to plan for your healthcare expenses and so on, just making sure that you are being covered adequately. If Chad and
Sorry, Sophia. Yeah, no, just a couple of things here. With the, I mean, if anyone does have a pension on the call, there might be a lump sum payout option versus a monthly income stream. That's stuff we can analyze if you're looking for any help. It might make sense. It may not make sense. And then to Sophia's point, she brought up the long-term care. I mean, the average age we enter long-term care facilities in this country is age 84. A typical stay is 2.7 years. And depending on where you are, I mean, when you get to that point, that could be $150,000 per year. So are you planning for that? So all the important considerations when we go through all this stuff. So I don't know if you have anything to add there, Sophia.
No, I think awesome points about the pension. Yes, we can definitely help you analyze which payout option, is most profitable or most suitable for your family and your loved ones.
Yep, 100%. Whatever creates the most favorable outcome.
Awesome. So here, there's a bunch of numbers, right? Well, let me sum it up for everybody on the call. Remember, hopefully you have been getting some statements from Social Security Administration in the mail, right? Those estimates from about your Social Security. Well, if you look at those statements, they give you a different estimates depending on what age you take Social Security. So there's main, I guess, ages to remember. So the earliest you can take Social Security retirement benefits is at 62. For most of us on this call, maybe, our full retirement age, again, depending on when your birth year is, it may be anywhere between 66 to 67, right? And then of course, the latest you can delay your Social Security to would be age 70. And so all at different times, when you claim it at different ages, just note that there's a whole calculation that goes into it. You are entitled to different benefits and so on. And part of our role, our expertise between Keith and myself is to help you analyze what option, when should you take Social Security at what age. And of course, taking account into your liquidity needs, your healthcare situation, and so on and so forth. I'm not even going to go into the whole thing about whether Social Security is going to be there for us in 20 years, but that's another topic. But here, we just wanted to make sure that you understand there are different options that could affect your income stream or your benefit.
And Sophia, I would like to go into that topic actually, because right now Social Security is projected to be bankrupt between the years of 2033 and 2035. I think they said on 2034, the last analysis. So this is going to sound totally counterintuitive, but if you've been a good saver and you have brokerage accounts, retirement assets, and so on and so forth, and you don't need Social Security, I could argue, but Sophia and I drill down on this stuff when we're doing the planning. I could argue that you take it as soon as you can get it, whether it's age 62 or whatever the case when you're retiring, because once you do that, when these government programs morph, they always give like a 6-month window to say, hey, do this. Otherwise, you're not going to be able to do it. So Social Security has changed quite a bit. It never used to be taxable and so on and so forth. But taking it and locking that in, you're going to be in a safer position. So everyone's situation is totally different on here, but just some considerations there, Sophia. So
awesome. I trusted you. I wanted you to take that and lift that heavy burden. Thank you.
Hey, can you guys go back to that real quick, just because we do have a question here. I think that's the right slide to address it. I do think it makes sense to make sure people really understand how and why Social Security works the way it does. Because the question is, why is it higher at age 66? And I'm assuming that really gets to why is it higher at 66 than it is at 62, right? And why is it even higher at age 70? I think that the answer to that is, 66 is when the government says you should be retiring. And for certain people, that's actually now set age 67 is when the government says you should be retiring. And that's when they want to give you your full benefit. And they say, if you take it at age 62, they need to pay you out for 4 or 5 years longer, right? And that's a monthly check for 12 months every year for an extra 4 or 5 years. So the government says, you are only entitled to this much money for the rest of your life. And so starting it earlier means we got to pay you out longer. We're going to give you a little bit less because we have to pay you out for longer. And if you wait till age 70, they say, thank you for waiting. We were able to save and invest the money instead of pay it out to you. We're going to give you a little bit more. It's like, think about interest. What is it? Like 8% per year, something like that, guys, that it increases 8%. Every year?
8% until age 70, correct.
Yeah. And so the government's just saying, because we haven't been paying you out for the last, 5 years or 8 years, since age 62 or 67, for letting us keep the money for an extra 3 years, we're going to give you a boost in your payout and give you an extra 24%, right, for that 3-year period. So really is just think about a big investing account that the government has. And if you take it earlier, they give you less. If you take it later, they give you more, just because the money was either invested for a shorter or longer period of time. Same as your 401k, right? If you take your 401k starting at age 62, you have less money in there. If you were to just keep working for another 8 years and keep investing and saving your 401k plan, 10 or 50% per year, 8 years later at age 70, you'd be able to take more money per year from your 401k account too.
That's an awesome point, actually. And there are so many other considerations here. So if you defer this right now, whether it feels like it or not, we're at historical lows from a tax perspective. You fast forward to your retirement, and that's what we're talking about today. Let's say at age 75, that's when your required minimum distributions kick in. So you have to start taking money out of your company plan, IRAs, and so on and so forth. Couple that with Social Security, and any other distributions you're taking from brokerage accounts, taxes could double. So there's a ton of planning that goes into this. But yeah, no, that's perfect, Chad. That was good. Okay. So am I good now, or do we have any other questions?
Nope, that's it. Keep going. We'll get to next questions when we get down to the Q&A at the end.
Okay, perfect. So yeah, I mean, the options here, we kind of already alluded to this a little bit. Take the full benefit. For most folks on this call, it would be 66 to 67, I would imagine. You start collecting earlier, to what Chad said before. You start collecting at 62, that's an 8% reduction in your benefit until your full retirement age. One thing that's super important here is, and I would recommend going into a Social Security office or visiting the website, ssa.gov. Once you apply for your benefits, you're deemed to have applied for all benefits. So you're locked in. And then what Chad said earlier, if you wait, you defer it until past your full retirement age, yeah, you're going to get that 8% increase year in, year out. But we talked about Social Security is way too political, way too big. It's not going to go away. But if they don't change anything again, going back to that 2034 year, something's going to have to change. So, and we watch this stuff every day to see what they're saying on Capitol Hill and things like that. So important consideration. You should consider it an irrevocable decision once you go to apply for Social Security. So working with an advisor and so on and so forth, that's incredibly helpful.
Hey guys, and as we get ready to advance past Social Security, so there's a couple questions, and we will address all the questions on this in the Q&A session, even though they're on Social Security. But I did just post in the chat box for everyone. If you haven't already registered, next week's session, next Thursday, is all about Social Security. And they're going to talk through like all of this same stuff right here. Like it's impossible to do retirement readiness. It's an income source. You can't do this topic without talking about Social Security. Next week's session, because it is such a hot topic, is dedicated exclusively to that topic. So I definitely encourage all of you that have some questions on Social Security or Medicare to consider attending next week, because I think some of the things coming into the Q&A in the chat box are going to be addressed.
Do we have, who's doing that one, by the way, Chad?
I think that is Mr. Henry in our office.
Oh, Henry, Arash,
in our app.
Okay, perfect. Yeah, so we pretty much everyone has their area of specialties, and that's great. No, that's always a great topic to keep on top of that. And then this one is just kind of a piggyback, basically, on Social Security here and discretionary spending. Long story short, if you're in a position where you can pay all your fixed expenses through your assured lifetime income sources like Social Security, pension, if you have an annuity, whatever the case, if you can satisfy all those fixed expenses and then satisfy your discretionary expenses with your variable accounts that you own and you manage, like cash in the bank and so on and so forth, that's a perfect retirement. So, and that's hard to balance. If you can do that, fantastic. A lot of folks can't, but that's why Sophia and I are here to help out too, if you need any help. So anything to add on that, Sophia?
No, I think you nailed it. Absolutely.
Chad? I don't like asking Chad if he has any comments, because then this is going to go for like 2 hours, but at any rate.
I have no extra questions. Honestly, fund discretionary expenses, but just remember that discretionary are things that are wants in many cases, right? Just remember what are needs in your life and remember what are wants in your life, and try to plan for the wants, because the needs you don't have a choice about. And I did get a call out, actually. We do have a number of questions in the chat box. Please do type those questions into the Q&A box, because the Q&A box allows people to thumbs up too. I think there's a question that some other people would really like to have us address at the end of the presentation, but if they're in the chat box, people can't thumbs up it. So please do use that Q&A box.
Cool. All right. And then Sophia.
Yep. So here, wanted to talk about 3 possible income strategies that you could explore. So here, number 1, we have interest only. This might be, I think a lot of people might be very familiar with, right? It's protection of principal and just living off of the interest that's generated from their portfolio. And the goal of this strategy is that you have the interest pool, and that it can provide income through, the dividends that's generated, and of course through interest payment that's generated from the bonds, from all the holdings within your portfolio. So you can live off of the interest alone. Number 2, I would say, it says it's bridge, but I would really describe it as like a split. So let's say if you have a whole $1 million, I'm just using it as an example, in your retirement account, right? Obviously, if you, going back to the earlier question, right? Forced or early retirement. You think you were going to work until 65, but actually something's happened that forced you to enter into retirement at 62 instead. Now we have 3 years of gap where we're not working, and we're also not yet taking Social Security, for example. So let's say we have $1 million in our retirement asset, right? You could tap into it, or portfolio in general, right? But you're never gonna eat the whole elephant in one bite, right? You will not be spending a whole million, hopefully, all in 1 year. So this strategy, the bridge, or I call it the split, is that you can single out a portion of it where you will need to use it as income generating for you to cover your essential expenses, while the rest of the portion of the account, I'm just gonna make up a number, maybe it's $800,000, $900,000, where it's left invested, right? The whole purpose of that is to continue to grow your money. So that would be a strategy there as well. And then the number 3 is having a systematic withdrawal. And typically you would, all 3 strategies, they have their pros and cons, right? You definitely want to work with your advisors to really see what's the best fit for you and what's more feasible for you. But the systematic withdrawal is you don't split your accounts into many different buckets per se, but you have a well-balanced portfolio, asset allocation, diversified portfolio, and the importance is that the advisor understand your needs in those gap years, right? They understand that you're not going to be tapping into Social Security yet because maybe you don't want reduced benefits, or maybe you do and still not enough to cover your bills, right? So they have that goal. They understand what your needs are, so they can structure the portfolio in a way that will help you get to the targeted income that you need, from your portfolios. Hopefully that makes sense. Anything else you want to add, Chad or Keith?
Not for me.
Go ahead, Chad.
Nope, I said not for me.
Oh, yeah, no, I was gonna say, I mean, generally speaking, maybe we have a slide on this. Depletion order, as far as, this is a question I get all the time anyway, Sophia. I don't know if you do, but it's okay. I have the Roth, the pre-tax, and the brokerage, so on and so forth. Where do I pull from first? With the Roth, to Sophia's point earlier, if no one's, I don't know if everyone's familiar with what a Roth IRA is, but that essentially grows once you have that account open for 5 years and you attain age 59 and a half, everything comes out tax-free. And unlike an employer-sponsored plan where you're contributing on a pre-tax basis, at age, again, 75, you have to take that money out. With the Roth, you never have to. So that's kind of over here in the corner, the Roth growing at 5-6%, whatever it is, and you never have to take that money out. But as far as diversifying your tax liability, that plays a crucial role in that scenario. So there's a ton of strategy behind this, and trying to keep it 30,000-foot view because everyone's situation is different. And no, good stuff there, Sophia. Thank you.
No, great point. Awesome. And I think this slide, yes. Well, for the first part of investing phase, you definitely need help to determine what your target asset mix for your investments, meaning, and maybe perhaps not everybody is familiar with this term. So you should definitely work with your advisor on this already, if not already, is to come up with, I like to call it a salad mix, to be honest with you, because you can have your protein, you can have your nuts, you can have your dairy, you can have your greens in there, right? And what is the perfect ratio that works for you? Right? And all the things that we've talked about, that we've addressed it till this point. And everybody is going to have different preferences and different needs over time because, right, depending on how much when are you looking to retire, how much do you spend, and how much assets is there, right? So, but it's very important. The first step is to really figure out what is that perfect balance or that ratio for you in terms of the target asset mix. And so things that you should be considering, right, and hopefully your advisors are asking you these kind of questions is what is your time horizon? How long do you expect your assets to last for? Hopefully, again, planning well into the 90s, if not longer, right? Talking about your risk tolerance. How much risk are you willing to take versus are you able to take? Those are two different questions, right? Just a quick fun example. I was talking to a plan participant into their 70s. And he was very aggressive in saying, right, yeah, I'm 100% stocks, 0% bonds, because yeah, I need to catch up because I did not invest money when I was in my 20s, 30s, or even 40s. So I had a later start. So I looked at him, I said, okay, right. So clearly you can stomach a lot of risk, but should you be doing so? Should a 70-year-old really be acting like a 20-year-old? That's the question of the day, right? Of course, and then we look at your investment experience, your financial situation, again, going back to your lifestyle, your assets, and how to manage your assets, your investments at least, and what has your experience with investments. Maybe there are some fear or there are some sort of reluctance and so on. And definitely these are all valid points that your advisor should know so that way they can help you determine again what's the best asset mix there. Anything else I missed?
It can become sorry. It can become complex with I mean, there's another rule of thumb here called the rule of 110, where essentially you take 110 minus your age, and that's approximately how much you should have invested in the stock market to outpace inflation and taxes. So Sophia, yeah, you coined it perfectly. That was great, but a lot of for folks that want to figure out, okay, because to Sophia's point, we have people coming in that are 100% allocated to equities, their stocks, and others that are risk averse. But as a general rule of thumb, yeah, I mean, it takes you 2 seconds to do that calculation, but that good stuff. Love it.
Awesome. So here, right, I think Keith, you talked a little bit about it earlier, right? We get the questions a lot, actually very often, is okay, well, in my retirement, I have all these different accounts, different tax treatments and so on. What is the best strategy to take the money out, right? In a very mindful way and tax efficient way also. Of course, the rule of thumb is also defer the taxes for as long as possible. But then again, it depends on your situation, right? If you were forced between, going back to the example, right? If you were to retire at 62, no income anymore, and let's say you haven't started taking Social Security yet, right? Maybe you're going to be in the lowest tax bracket. Maybe it does make sense for you to tap into some of your retirement accounts that are not associated to your employers and so on, because you can take advantage of the low tax environment in those years. But for some people, if they have Roth, maybe it's the right time to go ahead and tap into the Roth. So this is just a general rule of thumb, I would say, best practices. But again, it's going to vary situation to situation, household to households. I know we're coming up on time, so we wanted to, sorry for me to speed up a little bit. I just want to make sure we leave enough time to address all the Q&A in the Q&A box.
So again, just a quick synopsis here. I mean, just reviewing your goals, objectives, expenses. We kind of went through all this stuff, rebalancing the portfolio. I could argue that's probably more important now than ever because the markets are so volatile. So keeping up on, okay, making sure you stay within your risk tolerance for investing. And then the last one, and I harp on this, updating your beneficiary designations and making sure if you have a life-changing event, because whether it's a retirement account, insurance, annuity, it doesn't matter. All those assets pass by what's called operation of contract. So it'll go outside of the probate system in whatever state you live in. Whoever you have listed there, when you can list a real person, that's where the money's going. And one thing we don't want to do, and I see this all the time, is list a minor beneficiary. That convolutes things. So updating those beneficiaries, and if you have non-retirement accounts, whether it's a checking or a savings account or whatever, you can list a transfer on death or payable on death. So even though it's not a retirement account, it essentially acts as a beneficiary. So all that is protected. So yeah, that's a totally another topic. It kind of ties into estate planning, but make sure those beneficiaries are up to date.
Awesome. Thanks, you too. So really just think about next steps, everyone. At the top of the screen, if you do have questions, both Sophia and Keith's information is there, or you can scan the QR code. And that will link you up with this team as well to schedule some time. Definitely check out next week's webinar. Same time, same place, July 20 or 31st at 10 a.m. Pacific or 1 p.m. Eastern time. And then all of these replays are always available on our YouTube channel. I also pasted in the chat box, anyway, the survey link as well as a PDF link to today's slide. All of that will be distributed tomorrow via email from our team at BFSG, along with the replay link. And then I think everybody does get an automated email from Zoom that will also have a link to the replay as well. But as we get to questions, guys, we have a number of questions in the Q&A box with a lot of thumbs up here. I'm going to pull one that came really early though. Keith, can you go back to slide 13? I'm going to pull it from the chat box. Then I'm going to go to Q&A. I'll go back to the chat box at the very end because every question in the Q&A has a thumbs up. So I want to address those before anything in the chat box. But there is one you were talking about as you get back, back 13, next slide. And it goes to just withdrawal rates. The question is, how do RMDs factor into this, right? Like, doesn't RMDs require a higher withdrawal rate than this, or are we assuming that RMDs get reinvested?
No, so the required minimum distributions, again, for many on this call, it might be age 75, for some it might be 73. Whether or not you need that, you have to take that money out, and it's taxed as ordinary income. So that does play into this. And yes, you can count that towards your withdrawal rate. For those folks who are charitably inclined, there are qualified charitable distributions you can do, which completely removes your required minimum distribution from your taxes. So if you give 10,000, it's a common misperception. If you're writing a check to a nonprofit, for example, for charity, that's a deduction. You're still paying taxes on that money, but with the required minimum distributions, there's a way to structure where you can take that money out directly from the provider and reduce your income. So it's totally removed from your income. So there are a ton of things going on there. That's a great question, actually.
Yeah, the QCDs is a good one too. For anybody charitably inclined, I've seen, a client of ours that was literally taking money out of their retirement account, their employer-sponsored account in retirement, right? Paying all the taxes on it and then writing checks to charities. And we basically taught them how to set up an IRA, and every year pull the money they want to give to charity, which is like $30,000 a year, put that in your IRA, and then directed it directly from the IRA to the charities, and there's no taxes in that case. So it really just extends how long you can give to charities and how much you can give to charities because you don't have to pay taxes on it. So reach out, talk to your financial planner, your tax accountant.
It's yeah, no, for sure. But it's a win-win because you're reducing your taxable income and the charity is getting that benefit. So yeah, great point.
Cool.
Yeah. I think the
Tier two,
question might be right. So let me just rephrase the question to make sure. Mm, 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 mm. So I think RMDs, let's say, for example, it's not really the necessarily 4%, right? It's higher than that. The RMDs, let's just assume is 10%. So if it covers your expenses, then that's great. And if you have surplus, then we would definitely recommend you to reinvest, right? Otherwise, you can see here in this chart, right, if you are withdrawing at a 10% withdrawal rate from your portfolio, you will deplete it very quickly, rather. So I think maybe that was the question. And anyway, so I just wanted to kind of at least clarify. And the comfortable or the withdrawal rate, of course, is the rule of thumb, it would be the 4%. But of course, right, that's assuming that you hopefully you can reinvest whatever surplus that you have from the RMDs that you do not need, and that way it will lower your actual withdrawal rate. And then, of course, drag out your portfolio sustainability longer.
Hey, too. So to the Q&A box, again, and you can organize it too, so you can see most of that votes. But this person asked, wouldn't it be better to take early Social Security rather than wait till 70, even though the benefit's a lot bigger, and reinvest the money yourself? If you can afford to do so, and would that possibly even work out to more money than waiting till age 70?
So I would estimate I do like 300-ish appointments every year, initial financial planning, discovery meetings. And in many cases, yes, that does make sense, but everyone's situation is different. That's why it's so hard, you know what I mean, to give a definitive answer to that.
Yeah, I think something to think through is, especially if you are married or have a life partner, is, I mean, whose benefit is bigger, right? You know, what's life expectancy for both of you? Do you want that guaranteed benefit, and the other person might get a part of that benefit if your benefit was so much larger than theirs, right? There's just so many factors. I think to Keith's point is, that's what the financial planning process is there to uncover. If it makes sense to take it early and reinvest it, maybe. But would it be good to wait and make sure somebody else has a guaranteed benefit? And yeah, there's no right or wrong answer to that. Everybody's situation is different. So next question we have, and this gets into financial planner versus tax advisor. When you want to start thinking about the idea of retiring, where's the best place to start? Your tax advisor or your financial planner? I would tell you, I'll caveat this, we're probably biased because this is a team of financial planners. But they do work very closely with people's CPAs and accountants. So my guess is talk to both at the same time. Would that be right?
Financial planner is the best way to go. Just make sure they're a fiduciary consultant. If you go to letsmakeaplan.org, you can find a certified financial planner there, because CPAs, and many of them, and we work with, like Chad said, a handful of them, they have great intentions, but many times, like we do actual tax planning, we don't file taxes. But many times with CPAs, they're looking at in the rear view mirror, basically saying, okay, what's the damage? And kind of looking from that perspective, we're forward looking tax planning. So I would start with the financial advisor as opposed to the CPA, to be honest with you.
Yeah, I would agree. And also, a good financial planner, to Keith's point, if we're acting as a fiduciary, meaning placing your best interest ahead of our own, we will tell you where there are areas, expertise, and so on that it needs to be brought, a CPA or a tax advisor needs to be brought in. Right,
Yep.
just because we do not give tax advice. But again, many times we illustrate many situations, right? Scenarios for clients to kind of project out what if situations, so that way you can kind of already conceptualize in your mind, okay, if I were to do this, what may the tax implications be? And then, of course, we work hand in hand with the tax advisor to make sure that you make the best decision for you and your family. Hopefully that makes sense. But I would say, yes, financial planners are definitely a great starting point.
So the next question I have for you two is, I'm going to do two back to back because they're very similar, but they are different. The first one is, can you take Social Security at age 62, but then still work until age 65 before you collect your pension if you are lucky enough to have a pension plan?
You can. There will be a temporary reduction in the Social Security benefit, which they actually true up once you reach full retirement age. So there are some considerations there too. And Sophie, I don't know if you have anything to add to that, but that one's pretty straightforward, actually.
Yeah, definitely. There's nothing stopping you from doing it. I think it's really just considering the pros and cons and what suits, what is feasible for your situation. But yes, legally speaking, yes, absolutely, you can do that.
Yeah, you don't actually lose anything too. I think to the point is if you need to work till 65 to get your full pension, that could be a great strategy. Your Social Security benefit's going to get reduced, for that 3-year period just because you're still working, but Social Security does true it up. So it actually boosts your payment in full retirement age because they do make it up to you. So you don't actually lose anything by doing that, even though it might feel like you do because your benefits reduced for the first couple of years.
Yeah. And everyone who does that, they think it's a permanent reduction. It is not. So, and Social Security is actually very proactive about reaching out, and you don't even have to call them. They'll fix everything once you reach full retirement age.
Yep. And just it's along the same lines. If I retire at age 60, can I still wait until age 70 to take Social Security?
Yep.
I think that the one catch I'd say there, just make sure you don't deplete the rest of your nest egg in the time, right? If you have the money to afford to live off the rest of your nest egg and still have some left over, absolutely you can do so. But it would be a bummer to completely deplete your entire 401k just so you can wait till age 70 to get Social Security.
Yeah, we don't want to do that.
Okay, next question here with the most upvotes is, I heard there was a penalty if you don't take Social Security benefits when you're supposed to. The chart we showed, there's an incentive. I mean, just to get ahead of that, there is no benefit or there's no negative I've ever heard of to delaying Social Security from a payment perspective. That could be being confused with Medicare though, because there are penalties for joining Medicare too late. Anything there for you too?
There is a penalty for joining Medicare late. So yes, that is accurate. And Sophia, you have the insurance background. You could probably speak to this better than I, but if you defer, there is a penalty each and every year, and it never stops until you apply
That's
for.
right.
Yeah.
Yeah, absolutely right.
Yeah.
And I think also another misconception is RMDs. People confusing the RMDs age, which again, for some of us might be 72, 73, or 75, versus the 70, the latest you can delay Social Security to. But there is no penalty in delaying your Social Security benefit, beyond 70. I mean, it will no longer grow anymore, like the 8% straight line increase. It just stops and capped at 70. So it's just in your best interest to go ahead and take it at the latest at 70, but there is no penalty to wait beyond that age.
Yeah. Awesome. And just because you said the term RMDs again, and it is in the Q&A box, will one of you please define RMDs?
Required minimum distribution. That is from your tax deferred accounts. So basically think of it as Uncle Sam has given you a great tax break for all the years that you've worked. So by the time you're either 72, 73, or 75, again, depending on your birthday, the birth year, Uncle Sam is going to come knocking on your door and say, hey, Chad, hey, Keith, I've given you 3-4 decades worth of tax break. Now that money needs to come out. So then you have to withdraw a certain amount every single year, minimum, so that I can tax that money as ordinary income. So that way Uncle Sam has some money up in his pocket. That would be how I would describe it.
It's effectively the government is going to get their taxes one way or another. And for those really good savers that might never need to distribute this money, they're not going to let you defer it forever.
And that's where you can talk Roth conversions and things like that before required minimum distributions. There's a ton of strategies surrounding that as well.
Absolutely.
I think the other thing, just while we're on RMDs, is so the ages are all over the place at this point. So it used to be age 72, now it's age 73, and I think in about 9 years from now, it's going to become age 75 based on Secure 2.0, 8 or 9 years plus or minus. So definitely depending on your age and when you're going to turn age 72, 73, or 75, RMDs are going to be different, but it effectively is a required percentage of your savings tax deferred accounts that you have to distribute every year. based on some government formula.
Yep.
Roth assets, because I just saw it pop in, have no RMDs anymore. They used to in the 401k world, but they do not have required minimum distributions anymore. So definitely work with your financial planner and tax advisor to do, think through Roth conversions if it might make sense for you. Next question we have for you guys is, does the 4% expense rule that we mentioned include medical costs or just day-to-day expenses?
I mean, for a healthy individual versus someone who's not, I mean, that's all. The 4% is just kind of overall. I mean, Sophia, like I said, you have the insurance background, but just it's a rule of thumb. It really is. I hate that answer. I get it. But it's yeah.
The idea is, yes, it does include your medical expenses, but your medical expenses can be very large in any given year that cannot be ultra planned for.
Correct.
Yeah. It would be great if the 4% covers your medical expenses, but then that is, assuming perhaps, again, everybody's portfolio is going to be different, right? So let's say someone has a $1 million portfolio for % versus a $5 million portfolio for % withdrawal. Those are very different when we're talking money costs, right? The actual dollar amount. But I will say, if that can cover your medical expenses, you're gold. But if not, because again, sometimes we don't know what's going to happen with life, right? A lot of uncertainties. Then that's when actual proper planning, like Keith and myself, we will definitely help and address, sort of some of the worst case scenario that may happen when clients are not in their best shape health wise. So that are some of the potential blind spots that we want to be aware of, definitely planning forward, planning ahead. Hopefully that answers the question.
I would say in most plans that I do, anyway, I'm accounting for medical expenses at a given rate. So in addition to the living expenses and so on and so forth.
Yeah.
So next one I have, this is for somebody in their, call it mid-40s. Is it smart to start an income annuity plan now, monthly payments? So when I'm ready to retire and the 60s or 70s, I have an established guaranteed income source, or is it a waste of money to start that income, that annuity plan too early?
Okay, so with that limited information, let me just see. Well, if you're still working in your 40s, right, then it may not really make sense all that much to have that guaranteed stream of income activated right now, because it's just only going to bump up your taxable income, right?
I think this is somebody who wants to pay into it starting in their mid-40s and pay into it for 20 years so that they have a guaranteed source down the road.
Oh, I see. Yeah, absolutely. It's a viable option. All of everything, all the tools are there for a reason, and they have their own benefits and, trade-offs, I would say. But you really just wanted to make sure that it's the right one for you. And typically what we hear about, in the industry, annuities are associated with a very high cost. And especially on the back end of sales. So if you're not familiar, if you're not in the industry, you were not a producer, it's very difficult for you to really wrap that around your mind and say, oh, I'm actually paying 7-8% just in fees alone. But then again, maybe for some people, for that guaranteed stream of income, it's worth it. Paying a 7 to 8% fee is worth it. So it also depends on the policy or the annuity type in itself. But yeah, definitely a viable option to consider.
I mean, I would add to that is definitely talk to your financial planner before you kick off something like that. You think, I mean, starting in the mid-40s, you're talking 20 years of paying into that. And I think, Sophia mentioned 7 to 8 fees that could be right off the top, but most of them come with an annual fee of somewhere between 1% and 2% too. And if you just take that same money and invest it, and I have seen this happen, a balanced portfolio, I think people do like indexed annuities that might cap your gains, but also, protect your losses. If you had just invested that same money in the index and got the gains over the course of 20 years, you might find yourself with a lot more money than that. And you could buy an annuity that would pay you a better monthly premium or monthly payout in retirement than if you had paid into it for 20 years at the same time. So I think definitely things to think through, talk to your planner. Annuities are right for some people, not right for most people. But just definitely think through the costs and really what your goal is at the end.
Yeah. Not right for like 99% of the population is kind of where I land on that. But yeah, they're so expensive and you don't see the underlying expenses when you get your statements and so on. These are products that are sold if you feel more comfortable, then I would look at a Fidelity annuity, for example. We have no affiliation with them, but that's like one of the lowest cost annuity providers that you can get something like that set up. But yeah, to Chad's point, talk to somebody before you do it.
Yeah, I love the quote, Keith. Annuities are sold, not bought. Right? Somebody sells you an annuity because they are just not right for most people out there.
Because they pay huge commissions is what they do. Yeah.
I think that next question I have for you too, and this goes to beneficiaries, because we mentioned beneficiaries and you could set something up for your checking and savings account. Just to clarify, can that act like a beneficiary for other accounts if you didn't list beneficiaries for your other accounts? The answer is
what are the other accounts?
Yeah. Think like your 401k, you need to set your own beneficiary for. If you are married or have a spouse, it's required to be your spouse unless they sign what's called spousal consent. Good luck. I think where you might see that is if you're going to put it into a trust instead of giving it to your spouse, because that's effectively the same thing. But yeah, I think you want to set, it's different orders for 401ks versus pensions versus insurance. I think a lot of people think you set your beneficiaries for insurance. That applies to everything. That's not the case. You do need to log into each account, set your beneficiaries accordingly. If you have a pension with your employer, setting your beneficiary for a pension is not the same as setting your beneficiary for your 401k account. You need to log into them separately and set up your beneficiaries separately. No employer is assigning your beneficiaries to every single thing, pension, insurance, and 401k. I think it's a really common misconception out there that you set it in one place and you can forget it. Just not accurate.
The huge point, because I see this all the time. So yeah, there are different vendors that your company's working with. So setting those up, absolutely. So yeah, that's paramount as far as making sure they're up to date and so on and so forth.
Yeah, I think the stat is in the United States, because of things like auto enrollment, right? The average 401k plan beneficiary rate is close to 50%. Like you're saying 50% of the population, nobody knows where to send the money if you pass away. Like it's a crazy statistic.
Scary.
Right? It's scary. Yeah. And so while we're on beneficiaries, can you set up a charity, like a self-directed charity as a beneficiary?
You can. Yep. Yeah, you can do that. I mean, again, this goes down to the situation though, is okay, who's your primary? Is the charity going to be secondary? Because Chad, you brought up earlier, the trust thing. Generally speaking, we're not attorneys. I mean, we kind of have to wear that hat, but you wouldn't want a trust set up as primary. If all you want to do is leave money to a charity, you can totally do that.
I think, half the billionaires out there have pledged 99% of their wealth directly to charity when they pass away. So absolutely something you can do. So next question I have for you with a vote here is, if you're still employed, then you don't need to take Medicare. Is that correct?
That would,
yeah.
Sophia, okay. Yeah. I mean, that would depend on the size of the plan, who kicks in first and second, and that whole thing, right? As far as Medicare.
If your employer, I believe, if your employer is fewer than 20 employees,
is it 20?
Yeah, then most likely that the Medicare plan would be your primary. But in general speaking, like let's say if your employer is above 20 employees, right, and you're still working beyond 65 and so on, technically you can delay Medicare. You don't have to be enrolled in it right away. But you could also consider enrolling it and then have it as your secondary plan if you'd like, just for additional coverage. Again, it all depends on your health needs and the situation for the family. Mm-hmm.
And I definitely recommend for anybody like thinking through that is check out, like we have a replay, I think from last year on Medicare that you can find either on our website under videos and webinars or on our YouTube channel. Just find the most recent Medicare video. We did it with Brian MacArthur from Design My Medicare. What he would tell you is for 99% of people out there, Medicare is probably better insurance than your employers. There's a handful of employers that have like just such good benefits and insurance benefits that Medicare is not as good. but for most people out there, even if you're still employed, Medicare is actually a better option than your employer-sponsored, benefits. So just at least look through them and compare them, before you decide to stay on your employers. Next question I have for you is, we talk about this, the 4% rule quite a bit. Can we talk about how IRS rules around RMDs require us to tap into IRAs and 401ks? Like what should retirees expect to withdraw according just to the RMD tables, right?
With that, and Sophia, feel free to chime in, but you take if you're turning age 75, for example, you take the balance from your IRAs, the 401ks from December 31st, and divide that by 27.4 is what you do. And then that will give you an idea of what your RMDs will be. And with that being said, this is if you have multiple 401k plans, you have to take a distribution from each one of those.
Yeah.
If you have multiple IRAs, you can take a single distribution from the IRA, so you don't have to. That's when it starts to get messy, but that's the formula right now.
Yep. And the 27.4, in case you're wondering, you're like, Keith, how did you get that? Well, it's from the life expectancy table.
Yep.
Awesome. Okay, so that's the last one in the Q&A box. We might get more before we're done, but I do have a number in the chat box that I did promise that I would get to. But again, the Q&A allows people to thumbs up and upvote, so I wanted to start there. The first one I have coming back from the chat box is, does the Social Security benefit decrease if you have CalPERS pension benefits?
Just kind of changed right now. So public sector employees are actually getting Social Security benefits regardless of whether or not they paid into the system. So that it's a little bit of a fluid situation, but now I've worked with public sector employers and employees. They're getting checks from Social Security now. So I don't, again, know who your employer is or anything like that. That's a good reason to reach out. Sophia and I can help you out if you need any assistance on that, but that has changed.
Yeah, and for this person, I would definitely recommend joining the session next week. I think government sector employees, that are clients of ours, it's Social Security when we do that every single summer. It never really mattered unless you have a spouse in the corporate sector where, then it makes sense to join it just so you're informed about it. I think next week, it's just a small piece of it because Social Security applies to everybody now, but we are going to discuss the windfall elimination provision and the government pension offset during next week's session, since it has become relevant now for everybody in the United States. Next question I have for you is, I thought full Social Security benefits are vested once there are sufficient credits. I've also heard, though, that Social Security benefits can decrease over time if you don't continuously pay into it. Can we clarify?
The way Social Security operates is they take your 35-year history of work, look at your income, and then discount the 5 lowest years of earnings, and then that's how they calculate your benefit. So it's essentially a 30-year history. So if you continue to work, and I get this question quite a bit, it's like, okay, I'm going to get this another job, and it's going to pay me twice. That's not going to impact Social Security to any point, but that's kind of how the calculation goes with Social Security.
I would also recommend you to log on to ssa.gov if you haven't done so already. One is good to have a gauge, have an idea of your estimated benefits, but on the other hand, is that you can then check out the earnings record. There are times where we've seen that it was a 0 mistakenly, when in fact that year you did have income. So it's super important to go through those. And, Social Security Administration, they're pretty good about it. So if you caught some errors, go to them and they can fix it, update it, because they have all the records. So that's not a problem. But that might be affecting, that may definitely impact your benefit when it comes to Social Security.
Yeah, I did post the link to that in the chat box for y'all too. Again, I don't think you can copy and paste out of Zoom, but you should be able to click it and open in a browser to reference after we're done today. The next one, and this is the last one I have for you, unless another question does come in. But if I stop contributing to Social Security earlier, but don't take until 67, do I still get my full Social Security benefits?
You again get it based on they go back 35 years, 30 years to look at your income. So they would throw out those 0 earning years to calculate your benefit. That's how that would work.
Yep. So absolutely, yes, you do. Assuming you have 30 years of experience in there, that the zeros would zero out.
Right.
Awesome. You too. That's the last question I have for the group today. Any closing remarks before we wrap this up? And Keith, while you do that, can you put that disclosure up so compliance doesn't get on us?
Yes, sir. No, thank you. Thank you everyone for attending. This was awesome. If you need us as a resource, times are uncertain right now. Sophie and I, Chad, we're here for you. So you can always reach out. I left the contact page up, but otherwise, no, much appreciated.
Yeah, it's been a pleasure, and we're so glad that you're here. And again, we're here to serve as a resource. So if you need to reach out, we are definitely at your disposal. And hopefully we will be able to meet with you, at least some of you, on a one-on-one basis. But yeah, thank you so much for your time and your attendance.
Yep. Thank you, everyone. Have a great afternoon.
Thank you.